What's up, everyone, and welcome to the channel. Today's episode is going to be a very special one because I managed to get Edwin The Magic Engineer. That's the name of his channel, and of course, his name is Edwin Tracy. And I'm so happy that he was kind enough to actually take this interview. Initially, I wanted to just ask him questions, and I thought, you know what? Instead of asking him questions, why not hear from the man himself? And this is as raw as it gets, guys. I literally just asked him for permission whether we could do it as an interview format so that you guys can hear from him why he feels that Magic the Gathering is one of his investments. In fact, it's an alternative investment for him. As you know, I just recently shared that I diversified my profits from crypto into MTG, and I've always been wanting to interview Edwin and speak to him in breadth about this because I've had conversations with him about crypto, by the way, and we had lots of conversations about that. But we are going to be talking quite a lot about different types of investments, what kind of investments he does, his principles on investing. Guys, there's going to be a ton of value in this video. So I really want you guys to stay tuned and pay attention to this man. So hi, everyone. And hi Tracy, Edwin. And how's everything been?
Everything has been fantastic. We're having a great time here in Florida. Of course, the entire world is locked down, but the state of Florida has opened things up more than other places. So I actually like that balance because as long as we stay safe and we wear our masks, we have alcohol for cleaning our hands and things when we're outside in public, we're doing safe practices, but having a little bit of that freedom to have more responsibility to get out and do stuff has been great. So yeah, the whole world kind of sucks right now in 2020, but yep. My family's actually doing really well.
Wow. Okay. I'm really glad to hear that. On the side of Singapore, I think we are kind of doing okay. Recently, Hong Kong and Singapore just opened up, as in you can kind of, I think there's a way that we can travel to Singapore, travel to Hong Kong, with no quarantine. But I think we have to kind of do a health test before we leave, and then when we come back. So it's kind of good. I guess the world is slowly opening up. So far, I think we might go to a phase where we will allow more than 5 people at a table, because right now, if you go to the restaurant, you only can have a maximum of 5 people per table, which is sometimes quite inconvenient, especially Chinese families. We like to eat together, and usually it's like 5, more than 5 people easily, right? So that cannot, like, if you want to go in a group of 10, it has to be separate, like literally two different tables, and it's kind of weird, right? So
separate video, but COVID's impact on the world has been very interesting because based on the practices of individual cultures and different classes of society, people that have different just lifestyles and traits are impacted very differently. Mm-hmm. And the virus is just a string of proteins. It doesn't care. It's just something that moves through society based on people's habits and doesn't care about anyone's race, class, age, sex, anything like that. So it's been interesting to see how the virus impacts different societies and cultures and stuff. But anyways, that's a whole separate topic unto itself. Nothing to explain it.
But I think everyone wants to find out I think at the end of the day, I think everybody wants to know more about this alternative investment. But I think before we kind of get into that, I think everyone wants to know, like, yourself, like, I think you haven't really introduced what do you do professionally. And at the same time, we want to dive a little bit deeper into your investing mantra or methodologies. So, yeah.
So what I do for a career, I actually am a hardware and software engineer. And I actually have 2 degrees, one in electrical engineering and one in computer engineering. And right out of college, I went straight into doing motherboard BIOS for Intel. I was designing high-end gaming motherboards. And so I was writing the BIOS code, which started out in assembly, transferred to C. And while I was writing that firmware and that software, based on my hardware background, I was also involving myself in the hardware design of the motherboard. So I'm one of those few developers that isn't just hardware, just software. I'm kind of like a little bit of a mix between like the 2 of them. And that kind of makes me like a little bit of a rare skill set, which is good in some cases and bad in some cases. But a long story short, I worked for 15 years at Intel doing motherboard design for the longest period of time. And then I went over to R&D at the end of Intel career. And when I was working in R&D, I was one of those people that somebody would walk into a room and say, we need something that does this. And people need to go to a whiteboard and say, okay, I can write a circuit that does this. I can write some C# code in Windows that does this interface with it. Then I can write a Python test script that actually interacts with it. I was one of those guys that kind of brainstormed, figured things out, and then I would go into a lab and I would build things in actual hardware, soldering and all that. Or maybe I would just go straight to like a debugger and write a bunch of Python code and verify it works and then hand them a prototype. So that was a really fun job. Then 2 years at Hewlett Packard where I was doing BIOS for servers and nothing more than that. All they wanted me to do was write BIOS. And then and the first job was in Portland, Oregon. Then the job with Hewlett Packard was for 2 years in Houston, Texas. And then a couple of years ago, I was recruited by Lockheed Martin and moved here to Orlando, Florida, and to work on stuff that I definitely can't talk about at Lockheed Martin. But they wanted me there based on my previous skill set and because I'm a very narrow niche. And so right now, I'm definitely a senior developer at Lockheed Martin, and they want me for my hardware and my software background. So
And if you guys don't know what Lockheed and Martin is, right? Go and Google it, right? And then you'll know it's a listed company on the NYSE, or is it the S&P 500? I think on NASDAQ, right? S&P 500. Yeah, okay.
The big thing that people know about Lockheed for is if you've ever heard of an airplane called Blackbird and the SR-71, that was Lockheed Martin.
Sure.
And so they do a lot of government contracts. They design airplanes. They design all kinds of various things. Like none of this I'm saying is this is all public domain. People know this kind of stuff.
Sure, of course. Right. So let's not get too in-depth into that, right? Because you can't really discuss that. So I think, but what you can share is your experience with investing. So I think, Edwin, through my many conversations with him, he has a extensive holistic portfolio. Could you kind of care to share about how do you learn about investing, or how do you get interested in it? And so then
I can best describe this by telling a story.
Sure.
And I think people identify with stories the most.
Sure.
So like all typical other technical people, I mean, what I did at the very beginning is what all my peers did, which was basically, just the company gives you a 401k, they have automatic default things for you to jam your money into. And so I did that too. And until around like 2006, 2007, that's all that I did. I mean, I put my money into it and I had a pile of cash in there. But then something happened, which was kind of interesting. I was part of an Intel team that was working on something called PCM, phase change memory. And that company was forced out of Intel, broke off and became their own company called Mnemonics. And they were still owning that PCM technology. And I was in that group. Now they didn't allow us to leave. So for like out of my 15-year career, for like a couple months, I was literally not an Intel employee. But the interesting thing is that made my 401k, I got full control over it because it became my retirement account and there was no restrictions that the company placed on it. And so then I left Mnemonics and I went back to Intel, back into motherboards. And when I went back into doing motherboard design, I still had that account. And right about that time was around 2007. And I started like looking around at the housing market because, my wife and I wanted to, of course, upgrade and things like that. And what I can tell you is like, I started asking questions and none of the answers I got back from financial analysts made any sense. I started asking basic questions like, how come people that live in this area that have good incomes can't afford starter homes? And I got back really terrible answers. And another thing I asked was, okay, why is a bank gonna loan me $300,000 at like, 7% at that time? When they can like go out and they can go get a US Treasury bond for nearly the same interest rate at the time. And there's no way I'm as dependable as a US Treasury bond. So why is a bank going to loan me money? And sometimes there's even issues where like, my mortgage might be lower than some of the bonds that you can get. So it didn't make any sense. So I asked financial advisors that, and they didn't have any answer. They couldn't answer that question, which told me like, these guys have a knowledge gap. Something was wrong. So I started digging. And when I started digging, I found some really interesting information. I got to the answers I was looking for. I can now tell you exactly why a bank might actually want to loan people money for a mortgage instead of just buying a treasury bond. And I can tell you why, these ratios can get off in markets and stuff. But the big point I wanted to key in on is that people that had gone through school to actually get a knowledge of finance and history, they couldn't answer those questions. They had been taught a mentality that's typically referred to as Keynesian economics. And that can work inside of a certain bubble with a certain perspective when economies work a certain way. But there's things that happen in larger cycles in communities and societies and economics that can't be explained by Keynesian economics. It can only be explained by Austrian economics. And so I started discovering there's an entire world of other economics. And these two worlds can effectively collide when something happens that's outside of the definition of Keynesian economics, but is perfectly explained in Austrian economics. And that's where reality kind of comes crashing in, and then markets will end up crashing, and Keynesians won't even see it coming. And this was demonstrated in the 2007, 2008 crash. Most of the Keynesian economics followers, they didn't even see it coming. They literally thought everything was perfectly fine. But you had all these Austrians that were like flashing red signs and warning that there was problems coming because the models that they follow actually are the ones that dominated for that short amount of time. So when I discovered there was these separate worlds, I discovered that I needed to dig into it more. And so the first thing that I did is in 2007, I can't take too much credit for it, but I took that entire account that I said I had control over, and I moved the entire thing into just cash. And let me tell you, I had to argue with my finance guy for like a half an hour on the phone because he didn't want to do it. He thought I was being crazy. But I was like, I didn't know all the things I know now. I just knew a couple things. I knew there was a presidential election coming up. I knew that market seemed bubbled and it didn't make any sense. Houses seemed way too expensive. And I felt like stocks were a little overvalued as well. And I just wanted to just take my chips off the table and put them somewhere safe. My plan was to just do that for a little while. So I moved all my money out into just cash. And then the 2008 crash happened, and the stocks went down, housing went down, all these things crashed. And somewhere about 2009, I moved my money back into the market. And then when the Fed started printing and doing all this quantitative easing, 1, 2, 3, all these different packages, I rode that market back up along with that recovery. So that one there was some finance education, there was mostly luck. But then that thing that spurred me on so well to realize that there's more I needed to learn about, that I just started digging in. I started reading books, watching videos. I started asking questions. I mean, I got my head wrapped around finance as much as I possibly could. And that only comes out a little bit in the videos of my channel. Like the depth of what I actually had to dig into, I really don't have a chance to get into on my channel. And especially people wouldn't really follow it.
Don't mind me asking, but what were the various okay, so you mentioned you watched online videos, read some stuff. Were there any authors or folks or mentors that you kind of looked up to and you could remember, and that's how you kind of learned, or you you respect till this very day?
Yes. Okay, so I can definitely give those answers. So as an engineer, which is basically a scientist, the first thing that you have to do to solve problems is you have to get a very clear, what do you know is true? What is unarguable? What is verifiable, right? When you're solving any problem, the very first thing you have to do in a tech world is you have to get down to, here's the things I know. And then you build from that until you can work your way around and find a bug or find a problem. It's always that way. So I took the same approach in finance. I had to get down to like, what do I know? And in order to do that, I started listening to a lot of these Austrian economics. And there's a qualifier I need to put on this. There's a lot of people that are in like the precious metals community that I watched a lot of videos of. And we're talking like your Mike Maloney, your Peter Schiff, your Harry Dent, those types of names, your David Morgan. And it's not because I think the precious metals community is correct on everything. There's a little bit of fear mongering in there because they do want to sell their product. But in the process by which they're doing their little sales pitches and stuff, they're giving a lot of history. And I started hearing about things that you never hear about, and like where the US dollar came from, what a, what do you call it? A fractional reserve banking system actually means. and how it's going to turn out in the future, and why there was crashes that like basically elevated precious metals prices, and a lot more background on supply and demand. I mean, these precious metals guys, in their effort to just sell their product, which is sell precious metals, they did so much work educating that it filled in a lot of blanks. And there's so many things that just blew me away about, realities that actually exist. Like one of them, and this is one I tell to people all the time. If you walk up to anyone in the street and you say, where do eggs come from? They'll say, well, a chicken. You say, well, where does aluminum come from? If they're slightly more educated, they might say bauxite. It's mined out of the ground and then it's refined into aluminum. People tend to know where things came from. Well, where's the very thing that matters more than anything else to you in your life? It's what the topic of this video is about. You work for it every day. You think about it constantly. You know exactly how much you have in your bank account, in your pocket. It's a huge topic, money, right? And if you go up to a person and you say, where does money come from? They don't know the answer. And when you think about that break, that's incredible. So the very thing that people work and think about every single day, they have no idea where it even actually comes from. They think they do, but they really don't. And not until you actually discover the fractional reserve system where base currency is created, and then it's basically borrowed into the market, and then the banks actually use fractional reserve lending. And by the process of lending, they can grow the money supply through bank credit. Once you learn that process, you can see, okay, here's how money is actually created. And once you understand that, now you understand why loans have to happen. Because if loans don't happen, your currency pool just shrinks down, and then you get less currency, but with the same amount of stuff, which effectively means that prices are going to be going up. And the other way around, if they create tons of money and the currency pool expands, prices are going to start dropping. So you always understand those basic supply demand economics, but people don't understand what's driving it. And if you don't understand what's driving it and the things that have to be there, you don't understand the problem you're going to have, right? It's like if you're trying to fill up a bathtub and you have a leak in the bottom of the bathtub and you're constantly pouring water in. You can't understand the problem until you know there's a leak and how big the leak is and how many of them and stuff like that. So by learning these models, I got a better vision of how things actually work and why they work. And then what was interesting is I started to be able to pick out when politicians and bankers and world leaders were lying about things, because they were relying upon the fact that people don't understand how things actually work. And that was very interesting. Your discernment as an investor becomes large when you learn the process by which it works. An exact analogy is like if you go in to have your car worked on by a mechanic and he says, well, your muffler bearings are worn out. If you know anything about cars, you're going to say, there's no such thing as muffler bearings. What do you try? Okay, so first of all, I know you're dishonest. I know you think I'm uneducated. I know you're going to try to rip me off. And there's so much information that comes from that one thing. And I found a very similar kind of thing, which I'm not going to get into politics, but I will say I'm very upset that both political parties and all news media lies, at least to some degree. And I'm very frustrated about that because nobody in America nobody in the world is helped out when all of the people of a country are dealing with lies.
I think there's a lot of misrepresentation, whether is it media, whether is it come to marketing, just simple products that you see day to day, essential sometimes. As you mentioned, right? People may not be savvy enough to even identify the problems that they have. Right. And sometimes they may not even have a problem, but they're being sold as if they have one. Right. So that's something that I've always believed. And I think a large part of why content these days, right? That's why we're doing what we're doing, because we want to educate the public as much as possible. So that being said, right? I hope that you guys are kind of taking note of all this stuff, guys, because Edwin's stuff is really deep. So you might have to watch this video again. But Edwin, I think we have to come to the principles about your investing methodologies, right? Okay, if you had just 3 investing methodologies, what would they be?
I would say you have to be nimble. And that can mean many things, but that means you have to have the ability to invest in something when opportunity arrives. And let me be a bit more specific. I've evangelized to some of my friends and family the benefits of like, say having like for typical American families, say you have just at least 20 grand in cash, right? Well, what can happen with that? People often will look at it and say, well, you're not making any money in the stock market. You're not gaining any benefits in a bond, right? So that's true. But you know what will happen sometimes is like, say there's a neighbor down the street, he just lost his job and he's got his Jeep. And like the guy has to pay his rent. And his Jeep is a $10,000 Jeep, but he needs cash right now. And so you see him put the Jeep desperately up on the market for 6 grand or something like that. And if you just go offer the guy 6 grand, now you buy a $10,000 Jeep for 6, then you wash it, clean it up a bit, put it up for sale for 8,500. Now you make 2,500 profit. And then just in that one transaction, takes you a week and a half, bam. How long does it take you at 4% gains in the stock market to make that kind of money? And at the 4% gains you put in the stock market, it's at risk because things are swinging all over the place these days. But what are the chances that Jeep is suddenly going to lose 20% of its value at the price you bought it for? Well, it's not. And so the problem is if people don't have any liquid cash, they don't have the ability to seize upon an investment. And so now that concept hopefully is clear. It doesn't necessarily have to be just cash. It has to be something that's very liquid. So you could have another asset. If you have the ability to quickly translate it into cash, then another asset could actually be viable. And I don't need to go through a list of them, but because that's the requirement. Whatever it is you're investing in, can you go bam and turn it into cash? And so that's big. Another thing about it though, is if you actually have cash on hand, there's an awful lot of things out there, Magic the Gathering included, where people will say like, okay, I want to sell this card. I want this amount of money. Well, like if you're at like an event or something, say they're selling like this card for 2, this card for 3, this card for 4,000. These cards total up to like 20 grand, right? But that's like all of them together at like best market prices. If you walk up and say, here's 12,000 cash, take it right now, I'll buy the whole thing. A lot of times people will just say yes, because there's opportunity there, because a lot of people, they either don't have the connections to sell, or they don't really know how to sell, or they just don't really have the time. So you can often get really amazing discounts by having a cash profile. So that's one thing, having liquidity. Another thing is nobody, and I mean nobody, can make a perfect prediction on what's going to be the next asset to move all the time. And if you don't have any eggs in each of those baskets, then you don't have the ability to transfer from one asset to another. And so that's really the benefit of being diversified. Diversified is basically humbling yourself and admitting that you are not perfect. You cannot predict everything going up next. If you could, then it would be, hey, put all your money in Bitcoin. Now put all your money in Magic. Now put all your money in precious metals, right? You would just do it like that. But nobody can do that. Partially because nobody knows the cumulative effect of millions of investors around the world. That just unto itself. But then also because there are people out there are groups out there that know the way that the world is likely going to go, and they have enough money and influence and power to shove it another way, at least for an amount of time, so they can gain benefit from it. There is big market players sometimes that will front run markets, or they will manipulate things up or down, and they will do it at their timing for their benefit because they have the power and authority to do it. And that's not a good thing, but it exists. And if you don't recognize that, you can get caught upside down. Like you might think, like, say Microsoft came out with some great new thing. You might think Microsoft is the next stock I want to buy because they've made this great thing. Their stock's going to go up. And then they release the news and then their stock dives down 10%. And you're like, what the heck just happened? That happens sometimes. And a lot of the reason is because people will shove it pre-market in a certain direction to get the thing really cheap, and because a lot of people will have like automated sales and buys, like limit trading effectively. And so a lot of limits will get broken. Other sales will get triggered because this is all bot trading, not even people. And then once that price gets down, now they come swooping in and they scoop up everything before the market's had the time to wake up and be like, wait a minute, what just happened, right? Mm-hmm. That kind of thing can happen. So you have to be prepared for those things. And that's the reason to diversify, is because you can't always perfectly predict. And so if you have a little bit of real estate, you have a little bit of cash, you have a little bit of stocks, and you have a little bit of bonds, and you have a little bit of like tangible assets, like metals or Magic the Gathering, stuff like that. That's the reason, right?
Okay. So you believe in diversification. So the
yes,
third,
diversification.
so what's the third?
So the third, I would say, and this is learning to manage yourself and your emotions, I'd say is enormous. Like one of my biggest failures was right when Facebook IPO'd. I bought a large amount of stock at Facebook at $23 a share. Mm-hmm. And I believed in it. I researched the company. I knew what technical space they were going into. I knew it was a good call. And so they IPO'd at like 40 something. I waited till it, because I knew they always drop initially. So I bought in at 23 and then it went down to like $21. But I was so long in that investment that it caused emotion within me. And then the emotion that I had when it went from 23 to 21 caused so much fear that I actually sold. And when I sold, I took a loss. And now you go look at Facebook today. I mean, it's massively high. So was my investment correct? Absolutely. I was on the money. I had the same thing happen with Netflix, by the way. I bought a bunch of it at $9 a share. But anyways, the thing that I had to learn was even when you've done the research and you know what's going on, you have to pay attention to your emotional state, because your emotional state is going to be something that affects when you move into something, when you become ignorant of its actual moves in the direction it's going. You have to really monitor how you react to your investing. And until you get good at recognizing your own emotional state, when do you get greedy? When do you get fearful, right? Until you get good at that, I would recommend much smaller investments into things. Don't go big, because you will make mistakes. And when you make mistakes, they're going to punish you massively, right? So the big problem I had now identifying myself in the Facebook one is if I put in 1/10 of what I had put in there, I'm positive I would have let it ride. I'm positive of it. But it was because I went so long into it that it caused an enormous amount of fear. And it was the fear that made me sell, because I was losing so much money in that short period of time.
I think as investors, right? I think there's another thing that I kind of add on. Like your 3 points are exactly what I do. Like I think anyone who is an experienced investor, especially over time, they become experienced, right? And I think the fourth one is time. People tend to underestimate the time that is required for something to become profitable, a position to become profitable. Because everybody kind of, like you said, right? You knew that Facebook was a good buy. I mean, you are in the hardware, software, you are in the Silicon Valley, the tech space. So you knew for a fact it's just a matter of time before it becomes big. Same thing like with Netflix, and you kind of understood that whole, that the business model and so on and so forth. But I think everyone underestimates the time that is required to make money. And so this is something that we probably always underestimate. We know that it requires some time, and we even are told that these investments take at least a number of years. But because of the emotion that you just mentioned, you get so excited, you go overboard. Like you probably had the liquidity, hence you probably don't do leveraging, especially when it comes to stocks. Right? But
leverage, when you're wrong, you're really wrong when you use leverage.
Oh yeah.
So this goes massive.
Yes, it's a double-edged sword, right? You can win big, but when you lose, you get wiped out really quickly.
It's more than that. Using leverage is a sword that helps you this much on the way up. It hurts you this much on the way down.
Yes, correct.
Realize. The up, it does not gain you as much as the down loses when you use leverage.
All right, guys. So I'm sure Edwin has much more to share, but we want to have a part 2, and that will be coming out in the next episode. So see you guys, and we'll have Edwin join us in the next episode for part 2, guys, where he talks about the alternative investment that we want to hear about, which is Magic the Gathering. See you guys in the next episode.
Bye, everybody.
Bye.